Hello and welcome to Mutual Fund Corner. And on the show today, we'll be discussing two very important aspects in mutual fund investing that investors should be aware of. First is swing pricing and the basics that we'll discuss with Joydeep Sain, corporate trainer and author. And in the next conversation, we'll try and understand with Neerav Karkera of Fisdom how to analyze the cash position in mutual funds. Is this an important metric that investors need to understand or not? So let's get started with the first topic, that is swing pricing. Now, the Securities and Exchange Board of India, SEBI, wants to protect small investors who put their money, often significant chunks of their retirement corpus, into debt mutual funds. As a part of this endeavour, the capital markets regulator has introduced a swing pricing mechanism in open-ended debt mutual funds. Swing pricing is a mechanism by which redemption costs are apportioned among those unit holders whose trades impacted the NAV. The mechanism is designed in such a way that the remaining unit holders don't have to bear all the costs of the redemptions made by a select few. In a situation where there is a liquidity crunch, the swing mechanism effectively ensures that those redeeming their monies are charged for the redemptions, thereby seeking to dissuade them from doing so. Often, due to low liquidity, fund houses have to sell their investments to meet redemption demand. This leads to a fall in the NAV of the fund. So, no better than Joydeep joining us today. Joydeep Sain is the corporate trainer and author, joining us today to explain this complicated topic in a simpler manner. Joydeep, thank you so much for joining us today. Always a pleasure speaking with you. So, first up, if what I said about swing pricing, how do you put that in an illustration so that it's very easy for our viewers to understand that as well? What does this exactly do?
Sure. Just to recall a known concept, that of exit load. Exit load is defined, like if a fund says 1% for 1 year, it is defined for that period of 1 year. Now coming to swing pricing, there are certain terms or conditions when that swing pricing comes into play or it does not come into play. Like you said, full swing and partial swing. So full swing is a market-wide situation which is triggered by SEBI. It could be a market-wide aberration, dislocation, or a liquidity crunch kind of thing, which you referred to. And a partial swing is a kind of specific to a particular AMC or a particular fund. They may be facing a run on the fund and that kind of thing. Now coming to the question as to illustration, because that will help explain the concept for viewers and how does this work. There's a fund, let's say a credit risk fund with a corpus size of rupees 1,000 crore and an NAV of rupees 15 as an example. And let's say the terms mention that this fund can trigger or will trigger partial swing. And the definition of partial swing is redemption of 10% of the fund. And that extent of swing, partial swing, is 0.5% of NAV. So how would it work? If it so happens on a fine morning or not so fine morning, the fund faces a redemption of rupees 110 crore. So just to recall, fund size 1,000 crore, 110 crore, more than 10% of the corpus size. So that redemption happens and that partial swing is triggered. And the partial swing is 0.5% of the NAV, which means those who are exiting, they will get an NAV of rupees 15 minus 0.5%. 14.92 is the NAV they will receive. So what's happening here is, out of that 110 crore rupees which is being redeemed, rupees 55 lakh, which is that, that 0.08 into that number of units, rupees 55 lakh is being taken from the exiting investors, and it goes to the fund, which means it goes to the existing or remaining investors. So it's a kind of equity of fairness. Those who are like fair weather, those who are exiting, they are giving it back to the fund. Now coming to full swing, as an example, let us say there's a market-wide dislocation and SEBI triggers full swing of say 1%. So 1% of 15 rupees is like 15 paisa. So those who exit, they get 15 minus 1%, which is 14.85 rupees. So 1.1 crore is the quantum which will be deducted from the exiting investors, and it goes back to the fund as an equity or a fairness to the existing or remaining investors. So that's how broadly it works.
Okay, all right. So that was a very helpful example as well, Joydeep. So this basically is done in order to ensure that the remaining investors do not get impacted by the fall in NAV. And it usually happens when there is 10% or more redemption at the time, or there's a different limit for different cases.
Okay, two things here. Like you said, different limits for different cases. There is something called partial swing, which is kind of not compulsory for the AMCs. There is an AMFI guideline. If AMCs want, they can implement it, and they have to have it in the SID. Not like, they feel like doing it. No, not like that. They have to have it in the SID. So whatever terms are there in the SID, if that is triggered, the AMC triggers that. But these terms can vary from AMC to AMC. And what you refer to as fall in the NAV, I would put it slightly differently. Not exactly a fall in the NAV, but it's like, Just to recall what happened in March, April 2020, one AMC shut down certain funds due to a liquidity crunch. Those who exited earlier, let's say sometime in March or April, the AMC sold papers which they could sell. Let's say, as an example, AAA. Those who remained, they remained with a portfolio which is like AA or single A, which is not as good as when it was when the redemptions started. So it is like those who are exiting, they're kind of taking the cream with them. Those who are remaining, they have a relatively inferior portfolio. So that is the fairness I'm talking about. NAV swing can happen any which day. It's like the portfolio quality which remains with the existing investors.
Okay, all right. So I take that point. It's partial versus full swing is different, and it also depends from AMC. And the example that you gave of what happened during COVID is very important as well. So that means it's good for the existing investors. They are paid for being there with the fund at that particular time. But are there any limitations of swing pricing as well? Something that it does not consider and is something which could be negative?
I won't say negative per se, but limitations are there. One limitation is, like I'm saying, this equity or fairness. How do you measure or how do you quantify? Whatever number we discuss, like 0.5% or like 1% we mentioned, if it is like 0.5%, it is only an estimate or guesstimate as to what could be the impact. As an example, fair weather investors are exiting, those who are remaining, that may lead to a fire sale. It's difficult to quantify a fire sale. And secondly, as I mentioned earlier, partial swing is kind of not compulsory with AMCs, and the terms may vary. Somebody may say 0.5%, somebody may say 0.2 or 0.3%. Of course, depending on the AMFI guideline, the AMFI is defined as per that PRC framework. Some AMC may not even have it. So these two are the kind of limitations of this concept of swing pricing.
Okay, all right. So just limitations. There's nothing really negative about swing pricing as a concept here. Now we spoke about how it helps the remaining investors as well. What are the other ways when swing pricing helps investors? And do we see that happen a lot, like in debt mutual funds? I just want to understand, because COVID-like events do not happen so often. But when they do, is this something which helps the investors completely?
So on the frequency of happening, I would say ideally it should never happen. Okay, it has happened earlier. Like to recall, July 13, 11 years ago, market was tight. March, April 20, there was liquidity pressure. But why I'm saying ideally it should never happen, now there is a mechanism in place. There is a fund of 30,000 crore in the AIF format given to a particular large house, a leading house of India. What that fund will do is, in case of a liquidity crunch or a redemption pressure in industry-wide, they will buy these not-so-liquid papers from the mutual fund industry, and mutual funds are contributing to the corpus. What it means is there is better stability than earlier, and hopefully, ideally, we should never have to resort to that kind of situation. To the other question as to how it helps, so as and when, if in case it leads to fire sales, that compensation they have already received from the investors who exited earlier.
Okay, all right, get that point. So last question before we let go of this interesting and very useful discussion, Joydeep. Is it largely for debt funds only in India and everywhere? Does it help equity funds at all? Or you think this is something that just suits debt funds for now?
So conceptually and currently, as per regulations, it is for debt funds only. But since you raised this interesting topic, we can debate this. Equity, so equity, we have large cap funds, we have small cap funds. Large cap funds have enough and more liquidity. But in small cap funds, depending on how small the particular fund is, how liquid the counter is, so small cap definition, as you know, as per SEBI, is 251 and onwards. If the cap is like 100 or 2,000 or 4,000 or whatever, depending on the size of the small cap stock and the liquidity of the particular small cap fund, we can debate this. There may be a case for small cap funds also, in case there's a redemption run on a particular small cap fund. Those who are remaining, they may be left with illiquid stocks in the portfolio, which is conceptually similar to the debt fund swing pricing.
Okay, all right. So right now with debt funds only, but as you said, it's a debate and we'll have a longer discussion on this someday, Joydeep. But thank you so much for joining us today and explaining that tricky concept to us, and hope it helps the viewers as well. With that, we'll take your leave on this show right now. But we'll do one thing, we'll take a quick break, and on the other side, we'll talk about cash holding in mutual funds, analyze that portion with Nirav R. Karkera of Wisdom. Stay tuned for that conversation.